In this short video, we're going to look at the double declining balance depreciation method. This is an accelerated depreciation method. That means that we take more depreciation expense in the early years. Here's an example of what the declining balance depreciation method might result with. You see, in the early years we have more depreciation expense, and when we get to the end of the useful life of the asset, there's a lot less depreciation. This is different from the straight line depreciation method, which would have the exact same amount of depreciation every year. We have some equipment that cost $120,000. We're going to depreciate it over 5 years using the double declining balance method. As you see, the salvage value is $20,000. The double declining balance method works like this. You take 1 divided by the useful life, in this case 5 years, gives you 20% per year. But because it's double declining, we're going to multiply that by 2. That would give us a multiplier of 40%. Okay, looking at our spreadsheet here, we'll use Excel to show how the calculation works. The depreciation rate that we just calculated is 40%, and the depreciation expense is going to be the book value at the beginning of the year times 40%. Since this is a brand new asset, the book value is the cost. So we're going to multiply the 120 times the depreciation rate, and we have accumulated depreciation of $48,000, which matches the depreciation expense. Every year the depreciation expense is going to be calculated. The accumulated depreciation is going to add from the previous year. So our book value at the end of the year is equal to the cost less the accumulated depreciation, $72,000, and this becomes the next year's beginning depreciation. Again, it's going to be another 40% as our rate, and when we multiply that expense, we have this year $28,800. You see how we had more depreciation in the early year than the later year. Our accumulated depreciation is the previous year's accumulated depreciation plus the new depreciation. The ending book value is going to be equal to the cost minus the accumulated depreciation. The accumulated depreciation of $76,800 leaves the book value at the end of the year of $43,200. Okay, so now again we have 40% for our depreciation rate, and we multiply that and we get $17,200, and we add our depreciation expense to the accumulated depreciation, and we end up with $25,920. Alright, now this year we run into a little bit of a snag. You see, when we do the calculation, we end up with a book value of $15,552. The book value cannot go below the salvage value. This is because the double decline depreciation method has taken too much depreciation. Our accumulated depreciation cannot be more than the cost minus the salvage value. So in this situation, all that means is that we cap out the depreciation expense at the most we can take before having the book value go below the salvage value. So in this case, the most we can take to get our book value to our salvage value would be $5,920, and what that does is it leaves us with an accumulated depreciation of $100,000, our book value of $20,000. Because it's accelerated, we ended up taking the depreciation so fast that we didn't have any left over for year 5. Okay, so there's the declining balance method. We looked at it, and we even used Excel to learn how to calculate it.